Welcome to Get Started Investing, a podcast where we help you learn to invest in 15 minutes or less. Each episode, we take one real-world business story and apply a key investing lesson to help you build your investor toolkit. If you're joining us for the very first time, welcome. We strongly recommend that you scroll up and start at episode 1. While we are licensed, we are not aware of your personal circumstances. All information on this show is for education and entertainment purposes. Any advice is general advice only. So with that said, let's crack on. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Good to be here, back for another episode.
Yeah.
We're talking all things ETFs today.
We are, Ren. The story is out of Europe. We've found some data around who's buying what.
Yeah,
where the money flows are going.
Yeah, well, the news story or the data that was released was from Bloomberg Intelligence, and they reported on the biggest ETFs of 2022.
Yeah.
Jeez, almost forgot the year.
I know.
And then we figured for the lesson today, we would talk about how you can find that data here in Australia, but also what that data tells us here in Australia, because I think the data out of Europe, the data out of Australia, and I would bet the house that I don't own, the data out of America would all say the same thing. But we'll get to that.
It's the year of the passive.
Oh, we'll say it right now. It is the year of the passive ETF.
Yes.
The last couple of years, thematics had their moments, and God, there were a lot of them that were released. But this year, it's passive.
Yeah. Well, let's take a look at some of the data. So, ETFs that were listed in Europe have seen $61 billion, euros, I should say, 61 billion euros in inflows from the start of the year to the 19th of October.
Yeah, so all of these numbers are basically year to date.
Year to date.
Well, a couple of weeks out.
Yeah.
61 billion inflows into ETFs, and at the same time, mutual funds, i.e. like actively managed funds, have seen 200 billion euros in outflows in Europe. So, takeaway number 1, investors are choosing passive over active management.
Yeah, I think that sort of reflects what I've been doing the last
100%.
Last year.
Yeah.
Really, I haven't been focusing a lot on active. I do have some active positions, but we've spoken a lot about passive.
I think none of these takeaways are mind-blowing.
No.
But it's an important reminder that investing doesn't have to be mind-blowing.
Yeah.
It just has to be consistent.
And it's simple.
Yeah. So number 1, investors are choosing passive over active. They're voting with their dollars, and that's where they're going. What's takeaway number 2?
Well, it was surprising to see that when we dug a little deeper on the data, the impact that fees had. So we know that when you're setting up your core portfolio, going for a passive approach, looking for ETFs that have low fees is important. And ETFs with fees of 0.2% or less have captured 22 billion euros of those inflows over the past 6 months, while investors have withdrawn 28 billion in euro from the remaining ETF market. And this is according to Bloomberg Intelligence. And you can assume that a lot of those higher fee ETFs are often those thematic ones.
Yeah. Okay, so they're choosing passive in ETFs. They're choosing low fee ETFs.
Love it.
And then the third takeaway is that investors in Europe are choosing broad-based market ETFs. So the top 3 ETFs measured by inflows, i.e. the amount of money investors are putting in those funds.
Most popular.
Yes. Yeah, not best performers.
No.
Most popular in terms of voting with my dollars. Where am I putting it? Coming in at third place, if we set up our studio better, I could do a bit of a drum roll. But
Actually, I think we can. We've just got a new system. And can I give Ren a drum roll?
I gotta hear this.
No.
Keep all this in.
All right. Oh no, now I don't know how to stop all this. All right, sorry about that. We'll figure out how to do a drum roll. I think there is a drum roll setting on there.
Next time. No promises, but hopefully next time. All right, number 3, X-Tracker's DAX. Let's not worry about the tickers. They're listed in Europe. DAX, and that is, the DAX is Germany's market index, like the ASX 200 or the S&P 500. The DAX 30 is the one in Germany.
I've actually never heard of X-Trackers either.
No,
as an ETF provider.
So I guess it's like the European beta shares.
Who knows?
That's probably defamatory to either X-Trackers or Beta Shares, but we'll never know which one.
So $3.6 billion going into that one.
Yeah. Number 2, iShares Core S&P 500. $4.2 billion going into that one. For some reason, these numbers are reported in dollars, not euros. But anyway, so the German market index, then the American market index. Do you want to guess what number 1 is?
The Aussie.
The world.
The world.
iShares Core MSCI World Index. $4.9 billion inflows this year.
Just taking a super broad approach.
Yes.
Global.
So that's really the third takeaway, that investors aren't, going for thematic ETFs or sector ETFs or, equal weight ETFs. They're just going for the vanilla, low-cost passive market indexes.
Yeah, which is great to see. I am going to say, though, I am surprised that I'm not seeing any of the Vanguard ETFs in those top 3.
Well, it's almost like you looked ahead in the notes and you saw what we were going to talk about next, because while they may not be in the top 3, according to ETF Stream, Vanguard is winning the race in Europe. Because across all ETFs, Vanguard saw the largest inflows in Q3 and in Q2. So apparently BlackRock, which is iShares, were the dominant player in Europe, but Vanguard, the last 2 quarters, have had the most inflows, even though looking at this, BlackRock have number 1 and number 2 across the portfolio of ETFs. Apparently Vanguard's doing all right.
Well, I don't know what you found out when you were building your portfolio of ETFs to auto invest, but Vanguard, from what I can see, in your major indices, generally come out as the cheapest. For some of them. So yeah, it is surprising that they're not in the top 3.
Anyway,
all right, Ren, but that's Europe. Passive over active, low fees, preference for indexes. As we said, US, Germany, and all world. How is this, or is this playing out the same way in Australia? Are Australian investors, are you and I, in this bucket?
Yeah, well, we try and build our investor toolkit in these episodes. And so I guess the lesson here is that you can get this data yourself via the ASX. If they release a monthly investment products report and they make all of this data public, Excel version or PDF version. Bryce probably downloads the PDF version.
It's a riveting report.
Yeah. But look, it's not gonna get 100,000 followers on Instagram, but like there's insights in there, which I find interesting. So you can go on the ASX website and do your own research on what is out there, because it lists everything. Every ETF, all 259 of them are listed. So you can get a really good idea of what your investment options are. It also does listed investment companies, REITs, a whole bunch of other stuff, but we're here talking ETFs. So we pulled out the data for Australia, and would you believe it, Bryce? Very similar story in Australia than in Europe.
I would believe it.
Yes. So we, I guess, three key findings, 3 key stats that we're going to talk about. First of all, just the sheer number of ETFs just keeps growing.
Overwhelming.
Between September 2021 and September 2022, 14% growth in just the number of ETFs. Not money, but just the choices we had. This time last year, September last year, 227 exchange-traded products. This year, 259.
Wow. I mean, it's going to get to a point, and it feels like it is getting to a point where, and we actually know that it is at a point from the conversation in our community, that it now is overwhelming to figure out what ETF to invest in.
So you know how we've been talking about in Europe and now in America, there's single stock ETFs?
Yeah.
And so there's like a double levered Tesla ETF, a triple levered Tesla ETF, an inverse Tesla ETF, a double levered inverse Tesla ETF.
A lot of jargon there, but you don't need to worry about it.
But like the point is, for one company, there's like there could be like 5 or 6 single stock ETFs. They have just introduced the first single bond ETF.
I know. I guess what you're inferring is that if this plays out across the thousands of companies and the many different types of bonds that you can invest in, we're going to start seeing a ridiculous amount of ETFs.
Yes.
Beyond what is already a ridiculous amount.
And you know what? Vanguard Australia shares will still be number one. But we'll get to that. We'll get to that. So, yeah, just number one, increasing number of ETFs. Takeaway number two, Vanguard won the last 2 quarters in Europe. Who do you think's winning it in Australia?
The big V.
The big V. For September, $670 million in inflows to Vanguard. BetaShares second, $503 million.
That's actually way more than I would have thought.
Here's the surprise. Listen to the drop. Third, Van Eck, $113 million.
This shocks me that, and nothing against Van Eck, they've actually got some great products, but the fact that they are third on the list, where's Global X ETF Securities, where's iShares, where's SPDR, where's like those other big names?
Yeah.
What's going on?
Well, people are voting with their wallets, I guess. Well, here's the data point that stood out to me. The ETF issuer that had the worst month, iShares. A net outflow of $343 million.
Wow.
Maybe they closed a product down or something.
Potentially, yeah.
Yeah.
But yeah, Vanguard, BetaShares, Van Eck. Huge.
Yeah.
Huge inflows. So, Ren, the third takeaway, Europe, we spoke about, they're going global. US and Germany. Let's take a look at some of the ETFs that they're buying here in Australia, and it's a similar story.
Yeah, very similar. Passive, low fee, a lot of index funds with a bit of a caveat here. So a little bit different to Europe, but number one ETF in Australia. We've already said it. No surprises. It probably wins every month.
VAS, the Australian Shares Index.
Vanguard. Vanguard's just. It's just like prints money.
Yeah.
Well, it doesn't. It takes in money.
Yeah, it's very cheap.
Is it?
Yeah.
Cheaper than BetaShares?
No, I don't think so.
So it had $242 million inflow in September, which interestingly, if you do that maths, it's about a third of what Vanguard brought in. So,
Ren, just to close out the fees conversation, VAS is cheap, 0.1%. Management fee, expense fee, but BetaShares is 0.07.
Yeah.
For Australian shares.
Yeah. Now, this surprised me a little bit. So, in Europe, it was stock market indexes. The next 2 biggest ETFs in Australia for September were not stock market ETFs. They were listed on the stock market, but they invested in other things.
Okay.
Second was BetaShares Australian High Interest Cash ETF.
Okay.
With $230 million inflows.
Now, I would ask the question, why are people putting money into a cash ETF when we've got inflation ripping through?
My theory, and this is a theory based on nothing more than a cursory thought, is that institutional investors or like hedge funds, like big asset managers, are going to cash. And when they go to cash, they can either literally put cash in the bank or they could put it in something like this BetaShares, high interest cash, and get some yield.
Yeah.
Like maybe, I don't know what BetaShares is paying, 1% maybe. But it's like, it's better than nothing.
Yeah.
Especially when you've got $100 million.
Yeah.
So that's my unfounded theory. So that's number 2. Number 3, BetaShares Australian Bank Senior Floating Rate Bond ETF.
So for those not sure on what that actually means, a lot of jargon in there. What is a bank senior floating rate bond ETF?
Yeah. They need to like nickname bonds to have simple nickname ETFs. If you borrow money from a bank, let's say you get a mortgage. There are 2 ways that you could get a mortgage: fixed interest rate or variable interest rate. And a fixed interest rate is I borrow my mortgage to buy my house and it's 3% and I pay 3% interest for 30 years. That's fixed. And then you can get a variable interest rate, which moves as interest rates move. As the Reserve Bank of Australia moves interest rates up and down, the rate that you pay on your mortgage changes as well. It's the same for companies or governments that want to borrow money through bonds. They can get a fixed rate bond and that there's just a fixed interest rate, or they can have a floating rate bond where it moves with the Reserve Bank of Australia. And so this Beta Shares ETF invests in floating rate bonds, which are like your variable mortgage. As the Reserve Bank raises interest rates, the yield on these bonds increases as well.
Yeah. Inflation protection. Number 4, Ren, we've got Beta Shares Australia 200. So that's competing with the Vanguard Australia Shares Index. The ticker's A200. $72 million into that. That is the cheapest ETF in Australia for Australia.
Yeah, for Australia.
For Australia.
Do you know what the cheapest ETF in Australia is?
No.
I think it's one of the S&P 500 ones.
Okay.
But let's...
And then to close out the bottom, we have the Vanguard MSCI International Shares, so going global. The Vanguard Australia Shares High Yield, so that's people looking for equities that are spitting out good dividend return. And then, Ren, to close out, number 5 is the Vanguard MSCI Index International Shares, going global.
Yeah, just with a cheap... passive market index though.
Yes.
So I think that's the key takeaway. Investing can feel complicated. It can feel like you need to be smarter than the next person. You need to find something that no one else knows about. But really, like, the smart money, the big money is flowing into low cost, passive, just market index funds.
Yes.
The most vanilla of vanilla products. And if it's good enough for them, it's good enough for me.
Yeah. Well, great way to finish. Enough said.
And just, I found the cheapest ETF in Australia. Do you want to have a guess, or do you want me to just tell you?
Just tell us.
VTS, Vanguard US Total Market Shares Index, 0.03%.
Wow, that is cheap.
Will we ever see just a no-fee ETF?
Maybe.
It'd be a nice marketing gimmick.
It would be. Maybe we can do it.
No.
But anyway, Ren, let's leave it there. We will pick it up again next week. If you do enjoy the show, please rate and review on your podcast app. It does help us get exposure to new listeners, and we would really appreciate it. Have a great day.